This week on Wealth Track, 3 investment stars guide us through these turbulent market times. Goldman Sachs stock guru Abby Joseph Cohen, Loomis Sales bond legend Dan Fuss, and Julius Baer's international top gun Riyad Yunus light the path for a profitable new year. Next on Consuelo Mack Wealth Track.
You might want to avoid this route.
Stocks rose sharply yesterday, driven by reports of good earnings.
Opportunity favors the prepared mind. BlackRock.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Risk expert Peter Bernstein once famously wrote that the truth is in the consequences. Well, right now we are living with the consequences of several years of low interest rates, easy credit, and out-of-control credit creation. And the truth of what this all means came home to roost this year. Existing home sales are down about 20% versus a year ago. Existing home prices are down 4.5% nationally, the worst performance in decades. The financial markets have become abnormally volatile after being abnormally calm for several years, a state which lulled many investors into believing that risk was a thing of the past. Well, this week was no exception. On Wednesday, the Dow swung 382 points from high to low. Triple-digit swings are becoming par for the course. As you can see from this chart, price swings in the S&P 500 have increased dramatically this year. After 3 years of unusually low volatility, they are now above the historical average. We'll find out what that means from Goldman Sachs strategist Abby Joseph Cohen. The bond markets are also experiencing explosive price swings. As this chart illustrates, yields between low-grade, high-risk bonds and treasuries had narrowed to a mere 1% earlier this year. They have now tripled to over 3% as investors demand higher payments to hold the higher risk. And in some segments of the markets, no buyers can be found at any price. Loomis Sales bond fund manager Dan Fuss will explain why selling commercial paper or mortgage-related debt has become nearly impossible in some instances. And the write-offs of mortgage-related investments from major financial institutions like Citibank and UBS are mounting. Both have received billions of dollars of capital infusions from sovereign wealth funds of countries like Dubai and Singapore. We'll ask Julius Baer's international fund manager, Riyad Yunus, to assess the impact of these foreign government-controlled investment pools. And after leaving interest rates unchanged for more than a year, the Federal Reserve is now cutting them. This week, the Fed cut the key federal funds rate for the third time since September. Under Fed Chairman Ben Bernanke, the Fed is now aggressively involved in providing funds to financial institutions who have been unwilling to lend to each other. This week, the U.S. Central Bank worked in concert with its equivalents in Canada, Europe, and the UK to make billions of dollars of loans available to banks. Can the U.S. avoid a recession in 2008? Will the market volatility continue? And where can investors make money without undue risk? We'll ask our esteemed guests next on Consuelo Mack Wealth Track. What do we have to look forward to in the year ahead? How much will the economy slow down? Will the financial markets calm down? And where are the investment opportunities to be found? Well, we have 3 stars in the investment firmament to guide us. One of Wall Street's top market forecasters is Abby Joseph Cohen. She is Goldman Sachs' chief U.S. investment strategist. Her exhaustive research into the economy, the financial markets, and the nitty-gritty of corporate balance sheets has kept her in the forefront of Wall Street analysts. And in the world of bond investing, our next guest is a Hall of Famer, literally, inducted by the Fixed Income Analyst Society into their Hall of Fame. Morningstar calls him one of the best in the business. He is Dan Fuss, vice chairman of Loomis Sales and longtime manager, now co-manager of the 5-star Loomis Sales Bond Fund, which has a benchmark and peer-beating 10-year annualized return of more than 9%. And I said that is a bond fund with that kind of a track record. And our next five-star fund manager operates in the international sphere. He is Rudolph Riyad Yunus. He's head of international equity at Julius Baer Investment Management and co-manager of the Julius Baer International Equity Fund, among others. The fund's better than 17% annualized returns over the last 10 years has put it at the top of the International Stock Fund Pack. Welcome to all of you. It's great to have you here, and we need some real serious stars to guide us in these markets right now. Abby, I want to start with you. The biggest story, really, of the domestic stock market, at any rate, and the domestic economy, has been the correction in housing and the impact it has had on the financial markets. So, the surprise to me is, why hasn't it had a bigger impact on the U.S. economy? Why hasn't it?
We're very fortunate, Consuelo, that our economy is a very well-balanced and diversified economy.
Like our portfolio should be.
Right. Absolutely so. And what we are fortunate to see is that as housing has gotten weaker and weaker, and there's been some secondary impact on personal spending, we have areas of strength. Exports, for example, are growing 10 to 12%. And corporations who have great balance sheets continue to invest very heavily in new equipment, and they're also building new buildings. So one type of construction is declining, another type of construction is growing.
So how long, though, can the U.S. economy really, soldier on when the 70% of GDP, which is consumer consumption, is really starting to decline dramatically? And I know at Goldman Sachs you have a very low forecast for GDP, but you still think we're going to skirt a recession.
Never say never, but we do think that the probabilities do favor recession avoidance. This time last year, the economy was growing close to 4%, and we think in early 2008 will be closer to 1 to 1.5%, and for a year overall, about 1.8%. So growth at about one-half the rate that we previously enjoyed, but not a recession.
All right. Dan, despite the Federal Reserve's best efforts, and we saw a lot of efforts from them and other central banks this week, borrowing rates are still far above, at least they were the last time I looked, above the Fed's short-term target rates. Yeah. Why? Is the Fed, as some people are saying, pushing on a string?
Oh, I don't know if they're pushing on a string. I think all the central banks are dealing with a difficult problem. It's I can't even put a label on it, but specifically I think you're referring to the London interbank rate.
Right, the LIBOR rate.
The LIBOR. And the spreads over LIBOR can be very deceiving. For example, in Boston, a year and a half ago, a good floor plan, the Chrysler dealer type loan, was 2.5% over LIBOR. Right now, that type of loan is maybe 150 over LIBOR. That's not tight. Now, the problem is LIBOR is high relative to the Fed's rate and relative to short treasuries. So that market's very competitive by the banks. And boy, that seems surprising on the one hand, but it's not really. That's good business. It generates other bank business. And those loans are out there. So I think I get misled once in a while when I look at everything. I say, gee, this is a really tight market. It's not really a tight market for certain types of loans.
But overall, I mean, I've seen some figures recently that if you look at kind of the overall what it costs to borrow funds, that in fact that it is considerably higher than what the Fed's trying to do would lead you to believe, and that there hasn't been a lot of improvement, in fact, in borrowing rates, for the rest of us.
The spread against the short-term rate that the Fed sets and everything else is wider, but the short-term rate that the Fed sets has come down. LIBOR, not as much. LIBOR sort of ticked up and then came down, but not as much.
So is there a credit crunch? Is there a liquidity crunch? And what's the impact going to be on the U.S. economy?
There is a liquidity problem, and the Fed is dealing with that. I agree with what you said, Abby, and the corporate balance sheets in the U.S. are very strong. This is not like some of the earlier situations that we had. At the increment, I do worry about a financing availability for what I would call the more speculative, the private equity, the LBO type financing. That isn't out there right now. But the standard financing for the butcher,
For the economy,
baker,
the business will go on. They've got
it
access
is there.
to funds.
I've seen the numbers that indicate less willingness by the banks to lend in various categories. But when you talk to the bankers, at least in the Boston area and some other cities where I do, there is money there for, unlike, say, 1990 when we had a real problem. So I don't see it as a real tight situation. I see a liquidity problem. I see the central banks trying to deal with it. I see, to a degree, around the edges, a credit problem in the corporate sector, but nothing like past times.
All right.
So far.
Gee, that's encouraging. Riyadh, you have a cosmic view of all of this. For years, you have been warning about global imbalances. You've certainly done that the last time you were on Wealth Track, caused by what you call excessive consumption in the Anglo-Saxon world, in the U.S. in particular. Number one, is this going to cause a recession in the U.S.?
I'm not an economist, so, I mean, whether we get down to 1% or minus 1% or 0%, for me, does not make much of a difference.
But what does make a difference? I mean, how is this going to unfold, do you think, in the year ahead?
Definitely, we're going to see a slowdown. The degree of that slowdown depends how the Fed will maneuver to slow it down. If they're very aggressive in cutting the rate that the markets want, most likely we'll get to this high one-handle GDP rate. Otherwise, we could go lower. But for us, we have philosophical divergence with the consensus that we feel structurally we have structural problem in the U.S., and these are much more important than cyclical issues, whether or not we get into a recession.
All right. And so the kind of structural problems that you're concerned about, and especially as it would affect investors, are what? Just give us your headline.
Well, the trade deficit that we continue to see, that's no end in sight, despite the small improvement we see today, just a blip. The very high budget deficit, and the tanking dollar and the rising commodities.
Right. So those are definitely long-term.
And the very high leverage GDP, debt to GDP is like 200 and something %. So yeah.
All right. No, those are major. So, Abby, market volatility. You know, is the kind of market volatility that we've seen in the last year in the stock market specifically going to continue?
Let's be careful how we describe this.
Right.
A year ago, volatility was abnormally low.
Right.
And that created problems because it meant risk appetite was too high, and not just in stocks, but also in low-quality bonds. Low-quality bonds became significantly overpriced. We have now moved into a period in which volatility is abnormally high, and we think that this now creates some opportunities. In the equity market, we think that the S&P 500 is priced below where it should be. Corporate bonds, which we thought were significantly overpriced earlier in the year, we're first now getting interested. So even though we see that there is likely some economic deterioration, we think that the pricing of corporate bonds makes a lot more sense today than it did 6 months or 12 months or 18 months ago.
And so when you're talking about corporate bonds, you're talking about anything from junk bonds to AA, or?
We're talking mainly about the lower quality bonds.
Lower quality bonds.
Because the spreads that were available for bad borrowers, and whether it's corporates or in the housing market, there was too much willingness on the part of lenders to provide this capital without demanding that extra return. They didn't demand that extra yield, and we think that that was one reason that too much money went to places where it should not have gone.
Okay, so the high yield sector is beginning to start to look attractive.
Yes.
Dan, you know, can the credit markets get any crazier, and are you seeing opportunities as well?
Well, there are opportunities, but you don't have, particularly in the low-grade area, you don't have a lot of volume going on day to day. So
so that tells you something, right? I mean, are people just not, you know, willing to trade in that sector? Is that why?
Well, the bond market's a dealer function as opposed to an auction function. So, and right now there aren't too many people willing to carry inventories in the high yield area or in the investment grade area for that matter. But that does provide opportunities, but it's a nickel dime type of market where if you keep a bid in an illiquid market, and they're on names that you like, and you better set your price in dollar, not in spread. So at that dollar, you'll buy that bond. If you're there every single day, you're going to start to accumulate bonds. You can do that now. You could not do it last spring. You couldn't do it last year. You can do that now. You could have bought a lot of bonds last spring and last year, but in our opinion, the value that it wasn't there. So it's that type of market. It's not a booming market. It's a nickel-dime market. And I'm not so sure what it's going to be next year. I suspect it's not going to be a high-volume market. I think it's going to go on for a while.
And again, I just want to, for those of us who don't deal in the bond market on a regular basis, if the dealers aren't there basically to buy your bonds, I mean, they'll sell you bonds, but they won't necessarily buy your bonds, and then that means that it's not as liquid as it once was, right? Which makes it more problematical if you want to unload some bonds.
Right. The part that's in the middle, that the dealers, that's their function. They buy and sell bonds.
Right, except as you said, that's a voluntary. They can volunteer. Unlike in the New York Stock Exchange, the specialists are required. You know, their job requires them. But the dealers, if they decide they don't want to play, they don't necessarily have to.
And they'd be silly to play if they didn't want to. I mean,
right.
It's a very risky activity. So as a result, most of the things flow through. And if a going away type buyer such as ourselves is there with the bid, and that becomes known, then the dealer in that case will act as agent and take the bonds down for immediate sale.
So, Riyadh, we've seen a lot of upside volatility in the emerging markets in particular. You think about the BRICS and Brazil, Russia, India, and China. The rest of Asia, the commodity and the trade beneficiaries. Are we going to continue to see this kind of upside, do you think, in those international markets that have done so well over the last basically 5 years?
Usually, at the end of every bull market, the rally tend to be very narrow. In the late 90s, anything was not TMT, which is technology, media, or telecom, couldn't go up. And likewise, I would say the last 6 months, anything that's not Asia-related and commodity related as well did not go upward. So that's is a sign of weakness in our opinion, which means we are in the late innings of this rally, and we could see, in our opinion, we're going to see a big reversal next year in many of the themes that were winners this year.
So a big reversal in many of the themes. So that's trade, commodities,
we're going to see
Asia, China.
We could see a stronger dollar, in our opinion. We're going to see a weaker emerging Asia, and we're going to see a stronger European equity market. These will be our three main themes for next year.
All right. And so, Abby, what do you think? Because I know that you have been to China. Goldman Sachs is doing a lot of business in China. What's the Goldman Sachs view? What's your view?
Our view on the emerging markets is much less enthusiastic than we were on a short-term tactical basis. We still see very interesting long-term growth opportunities, but on a short-term valuation basis, when I was in China just a few weeks ago, the S&P 500 was trading at a PE ratio of 15 times earnings, the Chinese market at a PE ratio in excess of 35 times earnings. So we think that one of the outcomes of this rise in volatility and this market turmoil is that investors everywhere will be paying much more attention to valuation, and that's a good thing. When markets were not volatile, when there was lots of liquidity, it was price momentum. Investors kept buying the same things that had gone up previously. We think in 2008, we'll see investors move into the things that offer better opportunity. So there are some markets that we like better than others.
Such as?
Such as the developed markets, the United States, for example. We think that the U.S. dollar is in fact too cheap. And we will start to see some international flows coming into dollar-denominated assets. Maybe it's public stocks. Maybe it is money coming into U.S. companies. It could be the sovereign wealth funds, or it could be global asset allocators. And keep in mind, the low dollar does more than attract trade. If goods in the United States are cheap for holders of dear currencies like the euro and the pound, well, so too are our operating assets. And the United States, for the last 6 months, has been taking in more investment capital than any other country. And it's because there are good opportunities here.
So follow the money. And Dan, 9 months ago, you said if your brother called you and asked you what you should buy, in addition to saying he should buy your fund, which you are the largest shareholder of, I might add, you would have said buy an insurance policy in the form of a long U.S. Treasury bond.
Yes, I did say
What-
that.
Right, but your answer would be different today. You're
Yeah.
cashing in some of that insurance policy now.
It's about half gone, depending on the client, and it's
And the
it's
reason
been
is
great.
you're more confident now in other sectors of the bond market?
No, I'm less worried.
Okay.
I'm less worried about what might happen. 9 months ago, a year ago, I was very concerned that there was some possibility that this was, say, Japan of the early 90s.
Right.
And as we've gone along, seeing the response of the central banks, and other things, I'm less concerned about that. And I'm more back to figuring out where are we in the cycle. I think short rates are going to go down. I'm not so sure long rates are going to go down very much from here.
Okay.
The spreads are a whole lot better. The difference in yield between treasuries and corporates is
Are better.
immensely a whole
Right.
lot better. But essentially, we're going from long treasuries to 10-year corporates in the investment grade area. Spots in the high yield area are clearly
Or
attractive.
what Abby was saying.
Yeah, but
All
they're
right.
individual items. The overall area of high yield is not yet, in my opinion, a buy.
All right. So
And
we're
I agree.
going to have to hold it
We've
there.
got it made.
Because we've got to get to the one investment. So Abby, you said the U.S. looks cheap compared to a lot of other assets.
Mm-hmm.
So what would your one investment? What should we all own something of?
The one investment for me would be the Standard & Poor's 500, high-quality U.S. companies, return on equity approaching 20%, the highest in any developed economy. And if we avoid recession, which is what we expect, we think that U.S. companies will do very well. They'll do well outside the United States because of strong exports. They'll do better here than they're doing right now. Give it 6 to 12 months.
All right, and I might add that we put up that there are a lot of S&P index funds available. We just chose one of the oldest that Morningstar recommends, one of the oldest and the biggest out there. So Dan, your one investment is going to surprise people. It's not in the bond arena.
No, it's not. I think that we're in a stock picker's environment still. We've been in one this year, so I tend to look for the best stock picker out there, and so I like what the funds that Ken Hebner runs.
And you've owned some of his funds for a long time. And
I have.
And we chose, some of them are closed to new investors, but
Yes.
the one that we chose, the CGM Mutual of his, is still open to new investors. But so to be a consummate stock picker, that's going to be necessary in the year ahead.
I think so. I think it's a
All
good
right.
environment for a stock picker right now, and this is the environment that you're going to make money in.
All right. Riyadh, you are an excellent stock picker yourself. So to tell us, tell us what you would put in a long-term diversified portfolio. What should we each own something of?
Well, I mean, this year, for next year, I feel like Russia could be the best performing market. So I would say as a trade would be like a best trade for next year would be to have some Russian exposure. For a medium to long-term view, I continue to favor Central and Eastern Europe. We feel from a risk-reward perspective, that is the best region in the world, including China and India.
Very interesting. And Russia, there's a market vectors, Russia ETF. You asked us to find basically the broadest base closest to what the market would be, and that's what we came up with. Well, thank you, one and all. Believe it or not, I feel so much better ending this conversation than I did coming into it, given what happened in the stock and the bond markets this week. So, and you three are pros. So, I think your confidence in the process has made all of us feel better as well. Abby Joseph Cohen, great to have you here as always. Dan Fuss and Riyadh Yunus, thanks very much for joining us. Appreciate it.
Welcome.
Well, every week on Wealth Track, we leave you with one piece of advice, one action you can take to help you hopefully build and protect your wealth as well. So this week's action point borrows some extremely wise advice sent to clients by risk expert Peter Bernstein several New Years ago in his globally read newsletter, Economics and Portfolio Strategy. As Wealth Track viewers know, Peter, an octogenarian, is also the author of several best-selling books, including Against the Gods, The Remarkable Story of Risk. So this week's action point is consider the consequences when making your investment decisions. Now, most of us only consider the probable outcomes, usually the upside when we're investing. We don't consider the worst-case scenario, which, depending on your situation, could be devastating. So Bernstein's point is that especially in times of uncertainty, the consequences of losing should be the first consideration. especially as you get older. When you are young, losses don't matter as much because you have time to make them up. When you are older, mistakes matter more because you might not have another chance. As Bernstein said, he learned from the writings of the great 17th century French mathematician and probability pioneer Blaise Pascal that the truth is in the consequences. And with that in mind, we will wrap up this edition of Wealth Track. Join us next week as we discuss diversifying our investments among different asset classes, as Abby was talking about with private investment manager Peter Stamos, philanthropy consultant Tim Ogden, and gemologist Patrizia Di Carobio. And a quick reminder, if you want to see this program again, and I certainly do, just go to our website, wealthtrack.com. Starting on Monday, you can view it as a podcast or a streaming video. Until next time, make the week ahead a profitable and a productive one.
Opportunity favors the prepared mind. BlackRock.